Good morning, it's Jeffrey Cohen. May 12th, 2022. Context is markets open in 39 minutes. Futures are red, they're down. Maybe not quite as down as they were 5 minutes ago. We believe we're in a market correction. We believe we're in a market downturn. We believe we're in a market crash. Those are bold words, right? So what does that mean? What do you do about it? Well, we got some ideas. Plus, we found something in the data that we ran last night that we think is very important for you to know. So, let's start with, are we in a correction? How would you know, Jeffrey? So let's take a look. So we normally look at a few exchanges. We look at the S&P 500. We look at it, let's say, over a year. Go full screen. The day with the candles. Let's look at candles. And what we see is we see that the market is just in this steady decline. And volume is starting to grow. So volume up in a decline is a bad sign, because it means that you're confirming the rally, that people are starting to get comfortable with it. And so I get nervous about that, right? Because that says, oh, we're getting some confirmation. Now, it's not a lot of confirmation in terms of volume, but it's getting there. I'm not a technical person, so I don't look at all the charts, and I don't think I'm going to be able to divine patterns, but I can tell you that the S&P 500 is down. The NASDAQ is down. In fact, I got some text-based data if you don't like looking at charts. But take a look at the NASDAQ. It's down from 15,000-ish to 12,000-ish, right? That's 20%. And that's not even from the all-time high. That's just from the last high. By the way, it's going to be the same thing with the Russell. So now let's take a look at the data that we pulled up for you. This is some edge data, right? And so I want to make sure I'm showing you the right stuff that's going to be helpful for you. So and again, this is stuff that we actually run on a real-time basis for clients, and it's good for you to know it. So the first thing to know is the S&P 500, for the first time that we've seen in a really long time, it's down 4% over last year. So all that up, flat, down. The Russell is down 21.5%. So these are the smaller stocks. These are the stocks that we like to invest in. There's a story behind it. They're opening up new stores, or they've got new services, or they're doing research, or they're a pipeline company, right? They're small. They're not the Amazons and the Microsofts of the world. Those we don't feel like we can control. And then there's QQQ, which is the tech growth. That's down about 10%. Now these are excluding dividends. 1.3% on the S&P 500, so you really only lost 2.6 because you got paid while you wait. You paid tax those dividends though, so you're still down like 3%. And the QQQ pays even less, probably closer to 1% dividend, and Russell doesn't really pay. So the second thing we noticed was, if you invested in money-losing stocks, your variance continues to grow. 3.9 times 10 to the minus fourth. Expected return of 6.6%. It's not bad. Compared to profitable stocks are expected to return about 5% and have a variance of 1.4 times 10 to the negative 4. This compares to 1.1 times 10 to the negative 4 for the S&P 500. So you give a little more variance if you buy evenly weighted all the stocks that made a profit. There were 1,960 stocks that traded yesterday that companies made a profit. There's 633 companies that didn't make a profit. Now, when the stocks don't make a profit, the variance is about triple. It's about 2.8, 2.9 times higher. So I want to leave you with one thought. In a recession, okay, you're hearing it here. This isn't quite the data we found, but it's interesting data. In a recession, more companies have negative net income, right? They lose money. Bad things happen when they lose money. They become more risky. They have a higher expected return, which means prices dropped and variance increases. That's why you don't want to hold stocks in a recession. There's another reason that we found. I'm not there yet, but I'm going to just tell you. So by the way, edge. We're at the higher edge levels in our model. So if the market does go up today and you were to hold the 8 to 16 efficient stock portfolio, the odds are you're going to make 2 or 3 times the market return. If the market continues to fall, everything falls. It doesn't matter. So these are the edge. This is the edge right there. You want that edge. You buy a run. I get it to you the night before. Maybe I don't show it in the videos. No one has it but you. Right? You like that. We got edge. We got some new stocks in there. Not many, but some new stocks, right? So, and you've got a bunch of portfolios to choose from that have the same edge. And so you have choice. You don't get locked in. I like that. No lock-in. By the way, we don't manage your money. We just, you pay for the run. And you can also ask us to customize stuff, and we do that a lot for you. These are your downward edge. These are your shorts. So by the way, the number one short in our model has been the number one short for about 2-3 weeks. Yeah, it's down about 50%. So if you would have shorted it, you would have made a fortune. A lot of these other ones are also down. And so would have made a fortune. We don't short, but we run this so the people who like to bet against the market can do it. All right, Jeffrey, who are our negative beta stocks? So I know you like to talk about negative beta. So I talk about negative beta. So some people believe that negative beta stocks are going to operate different than the market. So of course, physical gold has negative beta. Of course, your short ETFs and your VIX ETFs and your US dollar ETFs are negative beta. Of course they are. But FATH is a meme stock. DraftKings, I don't know what's going on with DraftKings. It's worth some due diligence. Those are negative beta. So if you want to bet against the market and you're looking for that anomalous trading activity, FATH is a small manufacturer. They do like digital manufacturing out of, what does that mean? They do printing. They print things, right? And they're out of Wisconsin, right outside of Milwaukee. They're actually, we could drive there. We could go say hello to the CEO if we want. DraftKings is different. That's online betting. Who's online betting when everyone's losing their money? I don't know. Now, and those are the money losers, right? So those are your risky ones. Let's look at the money makers. Who's got a negative beta? So BTOG, Bit Origin, Chesapeake Utilities Company. Now that's interesting. IHS Holdings, Kellogg, the cereal company. That makes sense, right? Maybe they're doing well because maybe they raised prices, so the market's crashing, and yet Kellogg's, Tony the Tiger, is kicking ass, right? That's not bad. And then you got your other negative betas, which again is the short QQQ, the UUP, the UVIXI, and the VIXI, which is your VIX ETFs. What else do I have to tell you? Now I'm going to tell you the secret. Drum roll, please. Was the crash intentional? Is there intentional behavior out there? Is there something that's not quite random? Yes. Stocks that go up. We run our model and it outputs a spreadsheet, and these are the stocks that have positive net income. Okay? I find this interesting because I'm going to go 200. The color matters, okay? So what did you find, Jeffrey? Tell us. So here's what I found. I found when you look at stocks that are down, so this stock, Fast Radius, is down 92% over the average price over the past year. So think of it as the 253-day simple moving average. Now, if you look at FinViz, they do the 200-day simple moving average. This is the 253 because it's a full 1 year of trading every day. So fast radius, if you look at the volume over the last day, the volume is around 57%. So if the stock traded 100,000 shares, then on yesterday, Wednesday, it traded 57,000 shares. All right. Anything that we marked in blue is trading higher. I'm going to actually hide a couple columns and make it so obvious for you that you are going to get this. You are going to be like, Jeffrey, thank you so much. We don't care about the dividend for this discussion either. Variance might matter, so we're going to keep variance in there. Okay? So we take a look at arrival. Dead on arrival, get it? Pun? I don't know, maybe you didn't get it. So that's trading 260% of last year's volume, and that's trading at 14%. Upstart, we love Upstart. At 17%, this is a bargain. By the way, we believe fear of missing out is a cost-effective strategy right now, so we are not buying the downtrodden stocks. It's just not where we want to play right now. That's me. By the way, tell me what you think of the favicon. If you get a chance, just drop a comment below. Hey Jeff, what do I think of the favicon? Well, I like it. I changed it up. I think it's a little more stylish. And also, we're shaking hands because we're doing business together. Pineapple Energy did not really trade, 34%, so it's yellow. Kazoo Group, 232%. So if you look, there's a lot of blue and a lot of yellow. So Mega Matrix, this is the old Aero Century. It's out of China, tightly held. I wouldn't expect a lot of shares trading. Logic Mark, Biora Therapeutics, Newegg, Nighthawk, Equinix. Equinix is a company in transition. They're kind of Bitcoin related. They're out of Singapore. I don't know. So it's down. It's only trading 37% of last year, and the volume's down. You notice a couple stocks with the volume up. You notice Aplovin. I don't know Aplovin. Or Abcelera Biologics. But you see how it's yellow and it's blue. And it's yellow and it's blue because a lot of these stocks are so downtrodden, nobody wants to trade them. They're like yesterday's stocks, right? No one wants to eat yesterday's leftovers. Now, if you're Coinbase, it's 1,257. So Coinbase right now is a stock that is totally active. It's crazy out there. I would say if you're going to try to make a bet on momentum, it's Coinbase. And Upstart is another one, right? So that's how you use this data. Some stocks have less, some stocks have more. So when stocks make a profit, it's not one-sided. That's my point. Now let's move this over by favicon. And now let's take a look at the other one. This is the same chart, but these are your money-losing stocks. These are the dogs. Hiding some columns to make it easier for you to understand what we're trying to do. Gonna blow it up. So what's the first thing you notice? These are stocks that are down. Profitable stocks that when you compare them to the 253-day moving average are down. This one's only trading at 9%. Carvana, which is cool. They overpaid for used cars, right? And it's interesting model, right? Trying to reinvent the car business. It's down 87% over last year's simple moving average. And that one, the volume is up 722%. So Carvana is in play, which is interesting. And then we look, another one's up 166% in terms of volume, but it didn't make the blue. Amyris, Invite, these are down. I'm sorry, these are down. So these are money-losing stocks. I'm sorry, I got that confused. These are your money-losing stocks. Fubo. So Embark. So Carvana must have lost money. They paid too much, right? Embark Technology is at 2,000% of last year's average. It is totally in play. Fiverr International, 700% of last year's average volume. So what I noticed, though, because these are your down-run stocks, there's no yellow. Your money-losing stocks are being pounded lower. Pounded lower. High volume, on money-losing stocks, you have to go all the way down here to Smile Direct Club. I never even heard of Smile Direct Club. To get 43% volume. Just keep going. So, Cassava, no one's really trading it. Liquid Media Group. But it's blue. It's blue, it's blue, it's blue. Quintas is at 2%. But there's so many. It's 680%, 383%. You're down to 100 stocks, money-losing stocks that are down, and you're still all blue. Where's the yellow? No yellow. So this is why I think, my God, I keep going. 200 stocks. 200 stocks and what? 10 are low in volume. The rest are up in volume. Or about the same. It's a lot of up, a lot of blue. So this is what we noticed. We noticed that for stocks that are going up, meaning, not stocks going up, I'm not saying it right. Stocks with a positive net income, stocks that make our up run, greater than $500 million in market cap. So we're avoiding the memes and the small caps. Those stocks, so these are stocks that are down in price, are mixed. So profitable stocks that are down in price are both up in volume and down in volume, which to us makes sense. Money-losing stocks, negative net income stocks, okay? Those are basically just up in volume. So there is a concerted effort to pound down the stocks that are losing money. So what's my advice to you, right? This is not investment advice, but I guess it's as close as we're going to get to investment advice. If you paid us and we ran a job for you and had some conversations, I could give you real investment advice, build a plan, all that stuff, but that's not what this is. This is helping you. If you have stocks in your portfolio that are losing money and you don't know why you hold them, you don't believe in them, you don't understand their business, you bought them because you thought, they're probably a pretty good idea. Those stocks are being pounded lower. Those stocks are intentionally being targeted and driving the volume up and the price down. And if you need any proof, just look. Carvana, Amyris, Embark Technologies, Fiverr, Unity Software. It fell, they're pounding it down. All right, well, Smile Direct Club is one exception. It's the 42nd stock in here. And then you're still tons of up, very few downs. So we noticed that. We think that's important for you to know. That's going to be the key driver in all of this. We wanted to point out a little bit of market breadth for you. We did this yesterday and we thought it was important. So if we look at the breadth of the market yesterday's close. By the way, we love FinViz. Thank you, FinViz. Advanced versus declining. 22.5% of stocks went up, 74% went down. So if you had a portfolio of 100 stocks, it didn't feel so good. 42 new highs, 2,605 new lows. Fear of missing out is a cost-effective strategy. This is what we're talking about. If your stock hit a new low, it's probably going to hit a new low again, and again, and again, and by the way, on higher volume. Don't catch a falling knife. Be patient. I got to tell you, I always show you this, right? I have more money in my wallet right now than I do in my investment account, cash, because I took all the money out. I don't want to be tempted. I'm not buying any stocks right now. Nothing. I am out. I am in cash. Now, what I had invested is still invested. And by the way, I'm losing my shirt. I'm lucky I found this shirt. But I'm in. I like the stocks. I understand what I bought. I understand why I bought them. And I think they're going to go up. I'm patient. I don't need the money right now. I'm fine. But look at that. 1.6% new highs, 98.4% new lows. Okay, Jeffrey, smart ass. How many stocks are above the 50-day moving average? 2.5 months of trading, 10.5%. So if you bought a stock in the last 2.5 months, there's a 90% chance it's lower. if you bought a stock in the last 10 months, there's an 84% chance of it being lower. And don't believe the little ups and downs of the market, because look at that. So you felt good in the morning. You're like, oh, I'm going to make money. It's going to go from 11,600 to 11,800. I'm a genius. It went up 1%. But by the end of the day, you lost 3%. So I don't know when it's going to shift back. But for right now, you're in a market crash, market correction. It's down. Run away. Now, here's some data we like to look at. This is for all those like economics-minded people. I'm sorry if this bores you, but I think it's important. The velocity of money. The velocity of money is down. It is still, roughly speaking, at historic lows. This is saving us from what I call real inflation, 20% inflation. If the velocity of money were to jump up, meaning people are taking money and they're putting it to work and they're investing and they're building factories and they're making loans and they're borrowing money and they're investing and they're opening factories and they're building stores and they're buying inventory. Yeah, inflation goes through the roof. We are at historic lows. We've been at lows since the COVID. So since COVID, economic activity in terms of velocity of money has dropped. The money kind of went in the market. Think of this as blood pooling in a dead body. It doesn't pump. It doesn't pump fast. When you go on a bike ride, your blood is pumping. The velocity of your blood is high. If you just lay down and go to sleep, put your money in the stock market, passive, maybe buy some investment, some REITs, buy some fixed income, velocity slows down. That's why you could pump $3 trillion of liquidity in the market and it didn't drive inflation right away. The second thing I want to point out is M2, which is how much money's out there. Now, this is fast money plus some demand deposits, things like checking accounts, money market accounts, smaller CDs. And that keeps going up. Now, I don't know. If I'm the Federal Reserve, I got to do something about this. We've got to bend that curve lower because as of now, we're still printing money. We haven't stopped printing money. We had 1 month, or we had 1 week in January where we decided not to print any money. And we had a week in October of last year. But come on, guys. You're the Federal Reserve Bank. You're Federal Reserve Board. You're the Treasury. You know how to do this. You have been afraid to touch the money supply. No wonder why inflation's at 8.3%. I do want to talk about something, though, that was better. So the Treasury monthly statement and the daily Treasury statement and the monthly Treasury monthly statement of the public debt. So what I want to say is this. The Treasury balance, the money that the Treasury Department held, went up a little. Not a lot. Not a lot. Went up by $12 billion. At least that money was taken out of circulation. People paid taxes. The Treasury held it in a bank account. That's something. The other thing I want to talk about is real gross domestic product versus nominal gross domestic product. So, gross domestic product, real, declined by 1.4%. So that means if you take the actual nominal in regular US dollars, not accounting for inflation, if you look at gross domestic product, it went up a lot. Like 8%. 7%, I'm sorry. But with 8.4% inflation, real GDP declined by 1.4%. So what this tells you when you look at the chart is since Q3 of 2020, because inflation was lower, we've been able to grow the economy on an after-inflation basis. But now we're at the point where inflation is so high that it's overpowering economic growth. We still have more transactions. We still have growth. It's just not moving fast enough. And I want to remind you of an equation that we published on Medium just about a year ago, almost exactly a year ago. Again, if you're listening this far, you actually like economics, you like the technical side of economics and money and markets, and I want to give you just some of the intuition. And this is why we're in a crash, by the way. Inflation in the USA is a delicate balance. The way you do the math is you multiply price level, it's inflated, times the number of transactions. Because prices could stay the same, you could just have twice as many transactions. So if you have a lot of money, you get to buy and sell things really fast. You get to have economic growth. Economic growth sucks up money. That's a good thing. Those equal the money supply, which we use M2. You could use M1, M3, whatever. We like M2. It's clean. Times the velocity of money. So when the velocity of money drops by 20%, it's like multiplying M times 0.8. Okay? I could suck up a lot of extra cash by reducing the velocity of money. Now, it's hard for the velocity of money. There's a theoretical minimum for the velocity of money of 1.0. Money stays exactly still as 1. We're at 1.122. So for now, we're still at velocity of money. It can't really, it's like when interest rates are 0. You can't really fall further. So, price times transactions, or inflation level times GDP equals money supply times the velocity of money. You can't really shrink the velocity of money anymore, but you can affect the amount of money in circulation. By the way, Chair Powell, if you're listening, just do it. Don't talk about it. Just go suck $1 trillion out of cash. Just do it. Do it tomorrow morning. Don't tell anyone. Just do it. Clean it up. We got to take about, in my math, it's about $3 trillion worth of liquidity out. The Treasury could probably do a $500 billion to $1 trillion with tax receipts, and then through fiscal policy of not spending as much. But you, as a monetarist, you need to go out there and you need to take at least $2 trillion out, and don't talk about it. Just run off the debt. Do it painlessly. Wrap it up. And what will happen then, if we also can do some things to help the economy. Now, this is to you, Congress, President. Boost the economy. Don't talk about raising taxes. Talk about lowering taxes. Don't talk about raising regulations and punishing businesses. Talk about making it better for businesses. Make it better. Help companies grow. Make it easier to hire. Make it easier to sell things. Do things that help make a profit. And don't take the profit away. Profitable companies can focus not on the stock price being pounded down at high volume. Profitable companies can focus on investing in the future, buying back stock, paying dividends, helping out their communities. When we're profitable, we're much more charitable. When we're losing money, we're tightening every belt, right? And price. Price is the net result of all this. And so I want to thank you for listening. If you like the videos, please drop comments below. We like comments. We want to respond to you. We want to have that chit chat. You could do it on Twitter, that's fine, but I like it in the videos. Please comment below. If you like the video, you have any questions, do it. And then the other is hit the subscribe button. If you really like the video and it's helpful and you want to hear about future videos, hit the subscribe button. It really helps us. We do not get paid for making these videos. The only benefit we get is knowing that you're listening, knowing that you're watching, and that you appreciate it. And that maybe we help you, weather the storm. Thank you very much for watching. You take care now. This is Jeffrey Cohen, Chicago Quantum. Bye-bye now.